Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. Learn more about our show at insightfulinvestor.org. I'm excited to have Stephen Romick join us on the podcast today. Stephen is the co-managing partner of First Pacific Advisors, or FPA, and the longtime steward of the FPA Crescent Fund, recognized for his go anywhere philosophy and 32-year track record. FPA manages about $28 billion as of June of this year. Stephen, welcome, and thank you for joining us.
Thanks, Alex. Happy to be here.
Let's start, I guess, at the beginning. How did your passion for investing develop, and where do you feel like your core investment beliefs originated?
Passion's interesting because I think passion was really didn't come right away. I think that I had an interest, and I think I had a natural, proclivity for, attaching myself to the mathematics of investing, looking at tearing apart, the balance sheets and all the financial statements. And I think it was fun, but I was terrible at it at the beginning. I came out of undergrad and was offered a job by a gentleman named Jeff Nathan, who said to me, "I'm tired of unlearning MBAs, and so let me train you." But here I am with a Bachelor of Science in Education. It took a couple of finance courses, thrown into the wolves of the first day in the office, and given a stack of prospectuses that I kid you not was 2 feet high to take home and read. And I didn't know what the heck I was doing. So it developed relatively slowly. I went and got my CFA to try and teach myself, along the way to try and self-educate along with his help. But it really began back when I was in junior high school, and I began to invest with my grandfather. And then some friends said, buy this, buy that. I started buying some stocks, and it was really no more than gambling at the time. But because of that, I learned early on that, and I only made money at the very beginning. It was like, a clock's right twice a day, and I got that clock right. And but I learned I just didn't like losing money. And as I got better at it, the core beliefs, as you asked about, really, its foundation is just my distaste for losing money.
Do you feel like you were born with that focus on protection against permanent impairment of capital, or do you feel like you learned it and it stuck through experience and study?
I don't know if I was born with it, but I certainly received an inoculation at a young age. And so don't tell RFK about that. But be that as it may, I think that that not losing money vaccine that I had at an early age was really a very big part of it. But I also think a depression era mentality, just like, well, it can all go away tomorrow, kind of lives with me a little bit. I'm not really sure why. There are scientific studies that suggest that it takes a number of generations for your DNA to actually get back to what it was before some kind of traumatic event that your forebears might have had. But I do think that my success over time was driven by something a little bit different than maybe most. I mean, success is often driven by this blind ambition. And there's me, which is really somebody who was so fearful of failing that I worked my butt off to ensure that I wouldn't. I probably employed a similar work ethic as those who have that inherent need to win. So I thankfully ended up in the same place.
And I guess that could also feed into this notion of minimizing losses and permanent impairment of capital. Because if you're so focused on not losing, it's just a very different orientation.
Yeah. But if you set yourself up not to lose, but create the optionality to win, some of those options are going to hit. So, your returns are driven over time, not just by what you own, but what you don't own. And so avoiding, these mistakes can be a big driver, of your return. I think that minimize the mistakes in terms of the absolute number of mistakes, is where is the loss per mistake. And I think that's really key.
You talked about your investment philosophy DNA. What would you describe that, and maybe how your core beliefs have or haven't changed over the past 30 years?
At my core, I haven't changed. The one, as I said, and you brought up, I hate to lose money. One important way is to protect capital. And one way to do that is to make sure that you pay an appropriate price for an asset. And the only thing that's really changed since I've been in business is that I'm less willing to own lower quality businesses. But at my core, I'm really the same person. There's been, I've evolved as an investor over the years, but my core hasn't changed.
Some would describe you as a value investor. How do you define value, especially regarding this notion of a margin of safety?
I think you actually answered the question in your question is to us, and to me, value is just investing with a margin of safety, period. It doesn't mean buying companies at deep discounts to book value. It means that an asset you think is worth 100, you can buy it, at a discount to that, where you're able to absorb the risk of potentially being wrong and retain the optionality of being right. I think is a terrific way, and then, to make money over time. In the past, as I said, I was more accepting of lower quality businesses, and I had the protection of the balance sheet. Solid book value is support, adjusted for hidden real estate value and such. But with so much disruption from technological innovation today, many cheap companies are seeing or have seen their businesses disintermediated, and this has increased our focus on higher quality businesses. Balance sheet protection is good, but all else equal, give me a better quality business at a great price.
That makes sense. So obviously, there's times when your investment decisions diverge from consensus. Do you view that as being deliberately contrarian, or does it just stem from a more intuitive conviction about what is value?
I don't know if that it's intuitive, and we certainly aren't deliberately contrarian. The crowd isn't always wrong. We are able sometimes to develop a variant view that other investors might be less accepting of, or would prefer to wait to see how things develop and try and time it a little bit better. We know we're not good at timing. And so we're willing to look across, the chasm of when things are bad. It's sometimes hard to envision, getting up and climbing that hill to get to the other side. And sometimes with just that conviction that we will get there, we're not exactly clear on the time frame. But as long as we can get there, and we believe that our IRR, even, if it takes 7 years instead of 4 years, for example, and we can still have a good IRR in that circumstance, that can work out quite well. Sometimes all we offer is just patience to look longer term.
It is interesting how long term, that it seems to me the definition has changed over time. It feels like it's shorter, long term is shorter term now than it was maybe 5 years ago or 10 years ago. Is that your sense?
Oh, for sure. I mean, I think it's true across society. I mean, I have four daughters, and my two youngest daughters are, in the midst of this, came up in the social media generation. My older two didn't. And that short-termism is really, significant. Like, and if it didn't happen, if it's not recorded for posterity, it didn't happen, it seems. And everything has to happen. If it's going to be good, it has to happen by tomorrow. There's no willingness, it seems, generationally. It's not just speaking to my daughters, generationally, to do the work and what it takes to really invest that intellectual capital, your human capital, your energies to succeed over 10 years and focus longer term, on that. And we, never want to um, be those people who just demand success tomorrow. We know it doesn't happen immediately.
Yeah. And I guess in some ways, being patient could actually be an advantage because maybe other investors are less patient and it creates an opportunity.
Yeah, and I think that really is a significant statement today, because I think that with so many people like me who've been put out to pasture because they've become less relevant as investors, maybe some of them might have been but more dogmatic. Sometimes it's just, I mean, I'm not going to underestimate good fortune that, over the years that we've been in the right place more than we've been in the wrong place. But that has made it a little bit less competitive for us on the one hand, but also interesting with all of these pod shops and, momentum players and ETFs and so much money shifting from active to passive, when there is selling, it can happen really quickly. When there's that loss of conviction, it really can create tremendous opportunities. I think that and that might be more of our future than it has been in our past, which is actually makes me feel a little bit more optimistic about where I sit and here at First Pacific Advisors.
I know you've emphasized the importance of continuous learning. How do you decide when to be dogmatic, as you said, versus adaptable? And where's the line between maintaining core beliefs and evolving as markets change?
I don't think I ever said I want to be dogmatic. I mean, we never want to be dogmatic. We don't operate with perfect knowledge, and we know that. So we don't have that perfect knowledge of industries and businesses. I mean, that all continually evolve. There's always a regular flow of information, that we must consider. Some of it confirming, some of it disconfirming. So we therefore must always be adaptable. And so when you talk about our core beliefs, I mean, that hasn't changed. We have never been so dogmatic as to say, we're right and the world's wrong.
I guess the line is core beliefs in terms of margin of safety, minimize the risk of permanent impairment of capital, and then adaptable in terms of just about everything else. Is that accurate?
Yeah, that's accurate. But you also asked, and as a part of the question, I didn't answer to it. You talked about evolving with, that line between maintaining core beliefs and evolving with the markets. I mean, both can be true. I just don't think they're mutually exclusive, circumstances. You can have a core belief and yet you still need to evolve with the market. So markets can throw out different things to you at different points in time. We were able to buy interest rate caps when rates were, at all-time lows. And that's something we had never done previously. We were able to, we've only ever made one currency investment and we bought puts in the yen, more than a decade ago. We were willing to, it was very binary, but it was a very, very small amount of capital that was invested that if it paid off would offer us a very asymmetric rate of return to the risk that we assumed and the capital we invested. And that actually we were lucky and it did pay off in the time. But it was anytime you start, using derivatives, there's an expiration date attached to it. So you got to not only be right, but you got to be right in that time frame. So sometimes you could be dead right. You could just, it could happen, the day after, your options expired.
Right. Yeah, and also in terms of the evolution, in the beginning of our conversation, you talked about how just even the notion of margin of safety has evolved from maybe just pure financials to the quality of that business.
Yeah. I mean, I always hoped for business quality, but I was able to buy 30 years ago businesses that, had the great protection of the balance sheet, buy companies, at or below book value. And it was great. I just wasn't worried about that disintermediation that has really been happening the last, 20 years because of technological innovation.
And I guess that disintermediation and competition goes to protecting capital, right? Because you're thinking about permanent impairment of capital. How do you relate that to just regular market volatility and the price going up and down?
It's a great question because I mean stocks can trade at any price on any given day based on whatever animal spirits may have taken over the market or an industry or a specific company. However, that doesn't suggest anything as to how a company and its stock price might perform over time. We really try and shut out that daily noise. Volatility today doesn't say anything about a price tomorrow. It's like using a thermometer to predict the future. I'm looking out my window and looking at Santa Monica Beach and it's 75 degrees and sunny. But tomorrow it might be 65 degrees and rainy. So we really volatility doesn't really tell you much of anything. And volatility often, I think people will use it as a measure of risk. And we think that's, not appropriate, at least for us. But I see how it is a measure of risk for a lot of people because a lot of people will just use volatility, volatility will affect them in a way that causes them to get in or out of the market or individual stocks. It scares investors in and out of stocks. The market going up, we got to buy, or the market going down, we got to sell. So And then you talk about impermanent permanent capital, which is really something very different because no matter, stocks are going up and down on any given day, over a period of time, but you don't have to, nobody's telling you have to sell it, assuming you don't have any leverage and the banks aren't going to have a margin call. But so I really think that you're not forced to realize a loss. Sometimes it is appropriate to realize loss, going back to that question of being dogmatic. And, we don't want to be dogmatic. Sometimes you just have to realize, look, you know what, we were wrong, and so, while a loss should have nothing to do, permanent impairment should be because of you either made a mistake or you haven't your thesis has changed. Some of the information, as I talk about, that flow of information has come through, and you did your initial work, and your initial work guided you to buying something, or guided us to buying something, and yet new work suggests that the information flow has changed, and there's new competition, that's out there, for example, and that company might not offer the unit volume that it once growth that it once had. It might not have the margins that it once had. It might require a lot more capex to even maintain their place amongst their peers. So all that has to be taken into account, and when it stacks up against us, we exit. So when we build our models, we look at a low base and high case. Our low cases, is when we think we might could potentially lose money, hopefully not that much. And when the company isn't performing, doesn't quite execute on their plan as much as we would hope they would. The base case, the company executes in the plan, the economy is relatively good, and the market, that ends up being reflected in the stock price in the market, and we end up making decent money. And then there's the upside case where there's things are even better than we might otherwise. Well, they're as good as we hoped for, but they're not as good as we were willing to underwrite to. And so that's just, optionality to us. And sometimes the high case hits, sometimes the low case hits, but more often than not, have been more successful than not over the last, 3 decades, focusing with these very, very simple rubrics. And these are not all their models that appear to offer great precision when it has earnings down to the penny. It's just the result as a byproduct of the model. That's it.
I guess a simple way to think about it is you have a company out there that you think is worth $100 and it's trading at 80. And so you've got a decent margin of safety relative to what you feel it's worth. And then you buy it at 80 and you think it's worth 100. If new information comes out and you now realize, it's not worth 100, it's actually worth 90, that could be viewed as a permanent impairment of capital, regardless of what the market price is. That 80 could move up or down because that's just a reflection of what the consensus view is of that company. Is that a simple way to think about it?
The one pushback I have is the permanent capital, Alex, only happens when you sell something, but it isn't it's a permanent impairment of value in that case. Or maybe not even. Maybe it's went from 100 to 90 today, and maybe it ends up being 110 in the future because they right the ship. New information, suggests the ship is listing, and then the new management comes in as the current management team wasn't able to execute, and they end up, righting the ship and creating greater opportunity in the future, and things end up going swimmingly. A good example of that would be take Microsoft, right? Microsoft grew its earnings someplace around 18% from 2000 to 2009 for the first decade of this century. And the stock went down because it was priced so inappropriately going into it in the internet bubble. And at the time, there was a lot of fear that people were going to be using different form factors, in 2009, 10. People were going to be not using iOS and not DOS. People were not going to be using Word. They'll be using Google Docs. And all of that, didn't end up being true, as we now know. And they moved into the cloud and started doing other things. And that's a good example of a different management team coming in along the way and helping, push that stuff get this over the finish line.
You founded a quote unquote go anywhere fund 32 years ago when the concept was relatively unique. Why was this path so intuitive?
I guess I wanted more places to potentially lose money than others. I always thought it was silly to pigeonhole oneself. Why only buy large cap stocks when you can buy small? Sometimes one market cap presents more of an opportunity than other? Why only buy US when we can buy overseas? You've got Nike here, Adidas in Europe. You had Oracle here, you had SAP in Europe. You've got, you know, similar businesses in different parts of the world, and maybe they're being managed better in other parts of the world than the US, or maybe not. But not to look at the whole landscape didn't make sense. Then why only buy equity when I can buy corporate debt that might offer an equity rate of return? So it just seemed really silly to not consider opportunities right in front of you. A good example would be, let's just take real estate. If you were to look at an office building that's a four-story office building, the relatively small footprint, and compare it to a 20-story office building, compare that to the 50-story office building, and call them small, medium, and large cap stocks. The analysis is going to be the same. What is the occupancy? How good? What are the credit quality of those occupants? How good is the location of that building in the city that it's in? How good is that city in that state? Is there a lot of deferred capex, to bring that building along? There's a lot of TI that tenant improvements, expenses can be required to bring new tenants to the building as these leases expire, et cetera, et cetera. The analysis is the same. So why not look at small versus large? Or what if you're looking at that larger, bigger building, when you could buy the debt of that building and get, a 12%, 11, 12% rate of return? Good example of that would be Rockefeller Properties. When the keys were turned back in the late night or mid, I guess it was 90, losing track of my time, but call it 96, 97 time frame.
I guess it comes down to this balance between specialization and the benefits of that. And what you described, it's essentially the same type of analysis. So the specialization isn't as significant when the analysis is comparable.
Yeah, exactly. I mean, we look at, there's some industries we just don't, short product lifecycle companies, we kind of stay away from in those industries. Businesses that offer more of a binary opportunity, biotech would be an example. Doesn't mean one shouldn't invest in them. We just we don't bring great skill to the table in that regard. But if we can bring skill across different asset classes and geographies, and why not?
Is there a reason you typically hold more cash than many managers? And how does that fit within your bottom up process?
Yeah. Cash is merely a byproduct of our investment process. As we see opportunity, we pull cash down. When there's not opportunity, we end up selling some of the more expensive companies in our portfolio, and cash builds. So cash is truly a byproduct of our investment process. And there's been points in time when it's been drawn down into the mid single digits. It's been quite some time since that's been the case, but we hope for it to be the case at some point in the future.
What does it say when you have more cash? What should investors take away from that?
Well, it means that we aren't seeing the risk reward in the markets broadly when we have more cash. We might see it narrowly. We might be in certain asset classes, certain industries, companies, regions, but to put together a whole diversified portfolio is harder for us, and at certain points in time when markets are generally more expensive. So I think that the only takeaway one can have is that we aren't seeing the opportunity. That doesn't mean there isn't opportunity. Doesn't mean that we are right.
That's fair. Today, and maybe for some time, we live in a world of great uncertainty in the macroeconomic landscape. I guess you could say it's always uncertain. It just seems like it's more than normal. How do you reconcile your macro views with your bottom up investment analysis?
So as I mentioned, when we do our analysis, we build these models that have, as I said, this false precision, this low case, base case, and high case. And so our macroeconomic views end up being a backdrop that we use in those models, like in the bad economy. If we end up with a lot more inflation, we end up with higher interest rates, how does that affect, a business that you're looking at? And that will get built in often into the low case. Look, we try and handicap outcomes as to what is more likely, but we, at the end of the day, we're really trying to ensure is that company XYZ that we're buying today will still be company XYZ with its position in the marketplace, and with more earnings than it has today 5 and 10 years from now. Macroeconomic, again, you have to, with long term versus short term too, right? I mean, market, the economy is going to go up and it's going to go down. And while I think the economy is going to be better in 10 years than it is today, more GDP globally, I think the economy will be better in 20 years than it is today, than it is in 10 years. I think over time we will continue to grow. And along the way, there's going to be episodes of weaker economic environment. You're going to have recessions. And that will hopefully create opportunities to put capital to work.
So when you're buying companies, you're hopeful of the things that can go right, but you're also thinking about what can go wrong. How do you weigh macro risks like an economic downturn versus more specific factors like competition, business model weakness, and the company's level of innovation in your analysis?
That's really a great question, but not one that's possible to answer globally because different companies require different weights. Some are more subject to what the competition is doing. Some operate more, in a duopoly or oligopoly where it's less of an issue. Today, some are more impacted by the economy than others. So I really think it's company centric. We try and anticipate what can go wrong. And as we realize that more things can go wrong than will go wrong, but we're always trying to figure, okay, let's dream the dream on the one hand, and then let's live in fear on the other hand. So we kind of operate on a quotidian basis with that kind of duality.
Your fund has a over a 30-year track record, and few funds share that characteristic. What do you feel has allowed you to survive and adapt through so many cycles over the last 3 decades?
I think it begins with intellectual honesty, requires continuous learning, and a love of learning. Just every day is different. New companies, new industries crop up that can disrupt old industries, and having the portfolio that offers the flexibility to move around to take advantage of that in different environments is also key. And lastly, I would say that none of that could be done for me without my great partners Brian Selmo and Mark Landecker.
Well, in the last 30 plus years, you've lived through many major market cycles. What do you see as the potential drivers for the next big cycle?
There's been points in time where it's been more obvious to me what was going to be the driver. I mean, it was pretty obvious to me how much leverage there was in the system back, preceding the Great Financial Crisis, and how that really was going to be a great unwind as a result. And speaking to that specifically, as I said before, those returns are driven not just by what you own, but what you don't own. And we had sold out of all of our financials. And you're talking to a guy who started out as for the focus on bank and thrifts, working for the first investment partnership when I left college in 1985. But I think that low rates have perverted capital allocation. So a lot of capital has been put into manufacturing facilities and into R&D and other capex needs with an expectation of some future return. Well, an expectation of a future return can be lower if rates are lower, and high rates are going to cause us to change and magnify that with any company that's got higher debt levels, and that in turn can get magnified by the sovereign risks that exist with high debt levels. And so higher interest rates when these government could be a serious problem. Along with the weak economy, we could end up with stagflation. And I want to be clear, that's not me calling for that. I'm spitballing, with you at the moment. I mean, I, successfully have called, 7 of the last 2 recessions. Fortunately, I don't, commit the portfolio into that, to the great conviction I have in my economic calls.
To me, it seems like there's a variable that is at play today that hasn't been for some time, and that's the risk of inflation. We had low and stable inflation for decades, and it just seems that at least the risk of inflation being higher and more elevated for longer is greater today than it has been for some time.
Yeah, I don't know if that's fully in the market, but there's areas of opportunity. And we're there's certain parts of the portfolio we've been selling off as they've the good news is in the stock prices. We don't have that variant view anymore. And there's parts of the market where that isn't true today.
As you're looking at companies, how important is innovation in long-term investing? For example, you and I talked about in the past the difference between Netflix and Blockbuster and maybe some of the lessons that came out of that.
Yeah, I mean, you don't have to be a technological innovator to be a good company. We have owned, you know, Wholesome, a cement aggregate company, for years, and they aren't delivering a cutting edge product. But nor are they likely to be replaced in the near future by some other cutting edge product. But when you look at Blockbuster, Netflix is the example, and to addressing your question, I mean, Blockbuster was on the ropes for years. You know, I thought that company was going to be a problem because of for different reasons unrelated to Netflix. I thought it was going to be a problem with they were going to be challenged because the pipe to the home was getting bigger, and you had direct TV, that you could get pay-per-view with, and so the more options you could have on pay-per-view, the less of a need you had to go to Blockbuster. So we should have shorted it, but we did end up shorting actually two other public companies, Hollywood Video and Movie Gallery. And Netflix succeeded so dramatically because the bandwidth in the home, that pipe into the home, got bigger, allowed them to replace their ubiquitous red and white envelopes that carry their DVDs through US USPS, with streaming, which was not part of our video rental short thesis. But the most innovative companies often attract the greatest attention and therefore the highest valuation, and that valuation isn't always defensible. I mean, so we didn't know Netflix for a long time. We weren't sure how successful they would be in generating free cash flow. Then COVID hits, and the production stopped globally, and Netflix went down, and we were able to buy Netflix at that point in time. We don't own it in Crescent, you know, but it was something we owned, because of that. Often there's fear that some businesses won't stand the test of time because of the innovation, that's happening around them. And I gave that example of Microsoft, and other times there's this fear that shows up not just because of innovation, but because of you know economic concerns or some other exogenous factor, like when Facebook getting caught up in its Cambridge Analytica scandal, and what was that, 2018, which allowed us to buy what is now Meta, or the economic fears that impacted Google in 2011 allowed us to buy that company.
And I guess it's related to your earlier comment about constant learning and growing. And if you're too dogmatic in your business model and the market passes you up, then you effectively go extinct slowly. But if you're innovative and you're aware of the fact that maybe your business model will become outdated and you constantly evolve as the market evolves, then you obviously have less risk of permanent impairment of capital.
Yeah, but make no mistake, you can make money in a company whose business has been disrupted and is going away. If that company is a good enough business with a management team that's got their skin in the game and is mindful of what's happening, where they're just going to deliver that cash to their investors and let it, think of it as a net present value situation. They deliver the cash to their investors over time, and what's your IRR to that last dollar you get back? I mean, it could still be okay, from an investment perspective. Probably not worth spending a lot of time on those kinds of things, but it's still an interesting, thought experiment.
Of course, all of this comes down to the price, right?
Yeah. Well, price and management, right? Because you got a lot. The institutional imperative is more often than not, let's keep the company alive. Let's keep it going. Well, we're not going to be using the mail as much, and we're pitney bows, so we're going to start making lots of acquisitions. You have to be very careful. What's the intention of management? Are they willing? Do they have their money alongside of yours, and are they investing wisely, for the future, or are they just throwing a bunch of hail marys?
Let me ask you about AI, the hot topic today. AI is seen as both an opportunity and a risk. How are you approaching AI at a high level? And how do you assess which firms will benefit versus those that may ultimately be disrupted?
I mean, there's clearly going to be a lot of companies that use AI to improve their businesses, and some of which will just be by necessity. And that is, if they didn't use AI, their costs would be higher than their peers. Um, Biotech is a I think is a clear winner, because, and again, this is an area we don't have an expertise in, but with having mapped the human genome, a little over 20 years ago, combined with AI and machine learning, you really drive a drug development. The bench strength in labs has gone up exponentially, as a result. And there's going to be losers. There's going to be the call centers and other traditional advertisers that are going to, be replaced. But a lot of it is on the applied AI side of the equation. For the users of the AI, the guys that can take AI and apply it in their businesses, it really depends on how much of that gets competed away. It reminds me, for some businesses, it reminds me a little bit of those companies that move their, it's like an apparel retailer that move their manufacturing offshore. And vertically integrated apparel retail moves their manufacturing offshore. They bring it back to the U.S. at a much lower price than their competition, and this big pricing umbrella because their competition hadn't changed the way they were operating, so they just had margin expansion. Then those companies realized, well, we got to go overseas too. So soon everybody's manufacturing overseas, and that competitive advantage was competed away. So for some businesses in the applied AI, that's going to be the case for the future. And other companies, there's the picks and shovel companies that are going to be, winners. I mean, artificial intelligence is clearly a disruptor today. Some companies that are going to benefit by providing picks and shovels to the industry, like NVIDIA. And others, as I said, are going to apply AI to improve their businesses, like use it to replace their outsourced help desk.
Obviously, there's a big focus, on the AI spotlight of the big companies that you just described. But obviously, it's going to apply across the board. Obviously, there'll be other businesses that will benefit and others that are at risk. So I'm curious about how you think about all of that.
It comes back to the rubric we use, the low, base, and high. And as we look through to see what can happen to this company's earnings and cash flow over time. And we do the low base high cases. We're not looking out what the company's going to earn next week, next quarter, even next year. It's like, where are they going to be in a few years? And then think beyond that as well. So in our low case, a company, if we think a company is likely to be disrupted by AI, then we're not going to invest. But if we think that there's fears in the marketplace that an industry is going to be disrupted by AI, and we don't see it happening, we don't think that it's likely, but it's not improbable. So what we have to do is we look at these key performance indicators, these KPIs, is we have to evaluate as the information flow comes across our desk, as we continue to read and work on a daily basis, as we stay in tune and touch with these companies, is what is happening. Is AI actually a disruptor? And there's one industry which is going to remain nameless today as we are engaged in buying it, where there is that fear of AI disrupting it. And we think that it's possible, but we also think they can use it to their advantage. And we think too much of it has shown up in the stock price. And we think that risk has been largely discounted by the lower stock price.
There's obviously tremendous enthusiasm about AI. And I'm curious what parallels and differences you draw between that current boom relative to the late 90s and the internet enthusiasm.
Well, I think broadly speaking, I think there's more better companies today than there were then. I mean, simplistically. But there are also going to be a lot of companies that are going to go away that don't justify the price at which they trade, or any price for that matter. So I think there's going to be some of those companies as well. I mean, AI is the artificial intelligence is kind of like the two words of the day, and we're going to be talking about, if we did this podcast in 2 years, we might be talking about quantum, which is a thing. I mean, it's not commercially a thing today, but it will be, commercial viability in the future. And what's that going to disrupt? Who are the winners and losers going to be of that? And so we were just there's always a word to substitute, or, there's something that's sexy out there that people buy into and are wanting to hang their hats on, and it's some kind of panacea, and they'll value it as such.
Well, Stephen, I appreciate you taking the time and sharing your insights with us. I enjoyed our conversation, and I hope our listeners did as well. Thank you.
No, thank you, Alex.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for their participation.